More pain for property investors this week, with lenders continuing to lift mortgage rates and trim maximum LVRs, and more pain for banks as their credit ratings are trimmed, the federal bank tax becomes law, and South Australia imposes an additional levy on the Big Five. Welcome to the Property Imperative Weekly to the 24th of June 2017. Hi, I'm Martin North, Principal of Digital Finance Analytics. Another busy week of finance and property news. The regular pattern of mortgage interest rate hikes continued, with NAB lifting interest rates for all interest-only loans by 35 basis points, or 0.35%, whilst cutting principal and interest owner-occupied loans by 8 basis points. Westpac lifted interest-only loans by 34 basis points and reduced principal and interest loans by 8 basis points. The impact of these changes, according to Macquarie, will be net positive in terms of bank returns. AMP Bank also lifted investor rates by 35 basis points and reduced the maximum LVR on investor loans to 50%. These changes are making life difficult for some property investors who are currently interest-only loan holders. Do they switch to a principal and interest alternative, thus lifting their monthly repayments? Or do they wear the lift-in rates on their current loans, thus lifting their monthly repayments? It's a prisoner's dilemma. Either way, it is less likely that their current rental stream on the property will cover the costs of loan repayments. And we know from our surveys that about half of all investment properties are currently underwater when it comes to covering the repayment flows. More data this week to show that some major lenders are dialing back investor loans via brokers to try and manage their portfolios to within the current APRA guidelines. This trend, which we've highlighted previously, was confirmed in the AFG Competition Index. Mortgage stress was in the news again, with surprising results from Roy Morgan's survey, which showed that from their 10,000 mortgaged household sample, in the 3 months to April 2017, 16.8% or 666,000 mortgage holders are facing some degree of stress over their repayments. This compares favourably, they say, with 18.4% or 744,000 mortgage holders 12 months ago. It's worth noting their definition of stress, though. Mortgage stress is based on the ability of home borrowers to meet the repayment guidelines currently provided by the major banks. The level of mortgage holders being currently considered at risk is based on their ability to meet repayments on the original amount borrowed. This is currently 16.8%, which is well below the average over the past decade. Now, the DFA approach to mortgage stress, which looks at total household cash flow, not the theoretical repayment profile, indicates that mortgage stress is continuing to rise as incomes are crushed in real terms, costs of living rise, underemployment stalks many, all on top of a series of mortgage rate rises. Data from CanStar showed that basic variable rates jumped by around 30 basis points as increasing numbers of borrowers choose to go for fixed rate loans to try to control these escalating mortgage costs. But of course, many fixed rates already have higher costs wired in, but at least fixed rates will bring greater certainty. We looked at the correlation between mortgage stress and bank loan losses, which we expect to rise in coming months. Indeed, the latest data from Standard & Poor's showed that home loan delinquencies underlying Australian prime residential mortgage-backed securities, RMBS, increased from 1.16% in March to 1.21% in April. They linked the rise to higher mortgage rates. But whether you take the 666,000 households from Roy Morgan or the 794,000 from DFA, both are big numbers. There are indeed many households in mortgage pain, and all the indicators are that things will get worse in the months ahead. We expect APRA will demand the banks hold more capital. US rates were lifted by the Fed, and Moody's downgraded the long-term credit rating of 12 banks, including Australia's Big Four, after pointing to surging home prices, rising household debt, and sluggish wage growth. They said elevated risks within the housing sector heightened the sensitivity of Australian bank credit profiles to an adverse shock, notwithstanding improvements in their capital and liquidity in recent years. There were state budgets in New South Wales and South Australia. In New South Wales, stamp duty makes up a huge proportion of the state's income, that's $10 billion, with revenues last year jumping 10%, and are still expected to grow by 6% over the next 3 years. From July 1, stamp duty for first home buyers will be abolished for new homes up to $650,000 and with discounts on properties up to $800,000. Additionally, grants of $10,000 will be available for new homes of up to $600,000 and for first home buyers who build their homes. Stamp duty will no longer be charged on lenders' mortgage insurance. South Australia is surprised by adding a local bank tax to the Big Five. They plan to charge a levy on the major banks' bonds and deposits over $250,000, but will exclude mortgages and ordinary household deposits. The tax, to be introduced 1 July, is expected to raise $370 million over 4 years. The banks responded, including threats to pull jobs from South Australia. But then the banks are easy targets, and we would not be surprised if other states followed suit. Meantime, the federal bank tax was passed after a brief Senate review. Now the Treasurer has announced plans to change the way eligibility for a credit card is assessed, shifting it from the ability to pay the minimum repayment to being able to repay the credit limit within a reasonable period. Australians' wealth is overwhelmingly in our housing. Our housing stock is valued at the moment at $6.6 trillion. That's nearly double the combined value of ASX capitalisation and the value of superannuation funds. Housing is strongly linked to financial stability, as highlighted in an excellent speech by Fed Vice Chairman Stanley Fischer. He said there was a strong link between financial crises and difficulties in the real estate sector. In addition to its role in financial stability or instability, housing is also a sector that draws on and faces heavy government intervention, even in economies that generally rely on market mechanisms. Australian Housing and Urban Research Institute, AHURI, published a report this week on housing policies across the nation. They argue, and rightly, that Australia needs a federal minister for housing, a dedicated housing portfolio, and an agency responsible for conceptualising and coordinating policy. The current fragmented, ad hoc approach to housing policy seems poorly matched to the scale of the housing sector and its importance to Australia. There is no clear, systematic policy framework for housing across the nation, just piecemeal bits of policy which are not fit for purpose. Finally, the ABS released their residential property price data to March 2017. They said that overall prices rose on average 2.2% in the quarter. The price rises in Sydney up 3% and Melbourne 3.1%, were partially offset by falls in Perth, 1% down, and Darwin, 0.9%. Through the year, growth in residential property prices reached 10.2% in the March quarter. Sydney recorded the largest through-the-year growth of all the capital cities at 14.4%, followed closely by Melbourne at 13.4%. This ongoing rise may go counter to some recent data, although we note that the CoreLogic data this week also showed rises in most centres after recent softer data. The next ABS series, due out in 3 months, will be the one to watch. Auction clearances last weekend were quite strong, if on lower volumes. And so, as yet, signs of a real property slowdown do remain muted. And that's it for this week. Thanks for watching, and check back again next time for the latest instalment.